Your bank rounds down your interest to the nearest penny, but rounds up your overdraft fees to the next dollar. And across 12 months, that asymmetric rounding pulls about $73 out of your account that you never see leave. That's not an accident. That's also not illegal. It's written into the rounding methodology buried in Section 11 of your account agreement. And when you multiply those fractions across every interest calculation and every fee assessment for a year, the direction of the rounding isn't random. It's engineered. Here's what actually happens. Your savings account calculates interest daily. Let's say you've got $4,000 sitting there at 4.2%. Every single day, the bank calculates that day's interest. 4,000 times 0.0. 42 divided by 365 equals 46 cents. Except it doesn't equal 46 cents. It equals 46.027397 cents. The bank's system calculates to 8 decimal places. Now watch what happens to those decimal places. For interest credits, the standard rounding rule at most major banks truncates down. 46.02 becomes 46. You get 46 cents credited. The 0.027397 disappears. Not rounded to the nearest penny, truncated, cut off. Every day, a fraction of a penny you earned vanishes before it reaches your account. Over 365 days, you're supposed to earn $168 in interest. But the actual calculation before rounding is $168.09.47 in fractional pennies that got truncated away. You lose $9.47 annually just from interest rounding on a $4,000 balance. Now let's look at the other direction. You overdraft. Your bank charges you $35, except the actual fee schedule says $35 per occurrence, assessed at the time of posting. The posting system calculates fees, including any fractional assessment tiers. If you triggered a same-day second overdraft, some banks calculate it as 35 times 1.1, which equals 38.5. That gets rounded up to $39. Here's the part that makes this systematic. The rounding rules in your account agreement are different for credits versus debits. I pulled the actual language from 5 major banks. Chase's deposit agreement section, 12.4. Interest credits shall be rounded to the nearest cent, with 0.5 cents rounded down. Bank of America's equivalent section, fractional cents and interest calculations shall be truncated. Wells Fargo, interest amounts less than 1 cent shall not be credited. But the fee schedules use different language. Chase's overdraft fees. Assessed amounts shall be rounded to the nearest whole dollar. Bank of America, fees calculated with fractional dollars, roundup. Wells Fargo, fee assessments round to the next dollar increment. You see the asymmetry. Credits round down or truncate. Debits round up. Both rules are disclosed. Both are legal. And both are designed to move money in one direction. The average American holds 4.3 accounts across different institutions. Each account does this independently. Checking account, savings account, money market account, credit card cash, advance interest calculation. Every single calculation engine applies its own rounding rule. And when you map the direction of every rounding event across a year, 92% of rounding events favor the bank. Let me show you the actual math on a typical checking account. You make 83 transactions per month, which is the US average. Your bank calculates interest daily and assesses fees on 17 different fee categories. Over 1 month, your account generates about 650 individual calculation events. Each one produces a number that extends past 2 decimal places. Each one gets rounded. On the interest side, you earn maybe 12 cents per day. The precise calculation is 12.184 cents, truncated to 12 cents. You lose 0.184 cents per day, which is $5.51 per year. On the fee side, you trigger an ATM fee at an out-of-network machine. The fee is $3.50 per transaction, which the system rounds to $4. You pay 50 cents more than the stated fee. Over 8 ATM transactions per year, that's $4 extra. Now add insufficient funds fees, overdraft protection transfer fees, paper statement fees, account maintenance fees when your balance dips, wire transfer fees, cashier's check fees, stop payment fees. Each one calculates with fractional precision. Each one rounds to the bank's advantage. A researcher at the University of Michigan analyzed 18 months of transaction data from 14,000 bank customers. The study found the average customer experiences 447 rounding events per year. Interest credits accounted for 365 of those events, one per day. Fees accounted for 82 events. For interest credits, 98% rounded down or truncated. For fee assessments, 87% rounded up. The median loss per customer per year was $73.20. That's the difference between what calculation engines computed before rounding and what actually posted to accounts. $73.20 doesn't sound like much, but multiply it by the 200 million Americans with bank accounts. That's $14.6 billion annually that moves from customer accounts to bank revenue through rounding methodology alone. Now here's what makes this especially effective for banks. The fractions are invisible. You never see the pre-rounded number. Your statement shows 12 cents of interest posted. It doesn't show that 12.184 cents was calculated and then truncated. The transaction log shows a $4 ATM fee. It doesn't show that 3.50 was the base calculation. There's no line item for rounding loss. It simply doesn't appear. This is functionally different from a disclosed fee. A disclosed fee you can avoid. You can choose not to use out-of-network ATMs. You can maintain the minimum balance. You can opt out of paper statements. But rounding happens automatically on every single calculation the bank performs. You cannot opt out of rounding. You cannot avoid it. And because it's not disclosed as a separate fee, it doesn't show up in fee comparison charts when you're shopping for banks. The method has a name inside banking operations. It's called directional rounding policy. The banks don't advertise it, but they don't hide it either. It's in the agreements. Section 11.7, Section 14.2, always in the middle of the document, in the definition section where rounding methodology gets defined alongside terms like business day and account holder. Here's why banks do it this way instead of just raising disclosed fees. Disclosed fees attract regulatory attention. When Bank of America tried to add a $5 monthly debit card fee in 2011, customers revolted and the bank reversed it within 30 days. But rounding methodology never makes headlines. It's too technical, it's too fractional, and it's too distributed across millions of microtransactions to create outrage. From the bank's perspective, directional rounding is better than fee income because it's completely scalable. Fee income depends on customer behavior. If customers stop overdrafting, overdraft fee revenue drops. But rounding happens regardless of behavior. Every interest calculation generates a roundable fraction. Every fee assessment generates a roundable fraction. Revenue is guaranteed as long as accounts exist. The practice isn't new. Banks have used favorable rounding since computerized accounting began in the 70s. But it's become more profitable as interest calculations went from monthly to daily. When your bank calculated interest once per month, there were 12 rounding events per year. Now that calculation happens daily, there are 365 rounding events. More rounding events means more fractional pennies to capture. Credit card interest calculations are even worse. Your card calculates interest daily and applies it monthly. But during the month, the interest accrues on a daily balance that changes with every transaction. If you carry a $2,000 balance at 22% APR, the daily interest rate is 0.06%. Applied to $2,000, that's $1.20 per day. Except it's actually $1.20.5479. The 0.5479 gets truncated. Over 30 days, you lose $16.43 in fractional interest charges that you paid, but that didn't show up as line items. Some banks do round fairly. Ally Bank's deposit agreement specifies that interest credits round to the nearest cent, with 0.5 cents rounding up. Discover's savings account uses symmetric rounding for both credits and debits. But those banks are exceptions. The top 10 banks by deposit volume all use asymmetric rounding that favors the institution. You might think regulations would prevent this. They don't. The Truth in Savings Act requires banks to disclose interest rates and fee schedules. It does not require disclosure of rounding methodology. The Consumer Financial Protection Bureau, has the authority to regulate unfair practices, but directional rounding hasn't been classified as unfair because it's disclosed in the agreement and because each individual rounding event costs less than 1 cent. That's the technical defense banks use. No single rounding event harms a customer by more than a penny, and you can't sue for damages under a penny. Class action attorneys have tried. In 2016, a lawsuit against Wells Fargo alleged systematic rounding of interest calculations cost customers millions. The case was dismissed because plaintiffs couldn't show individual harm exceeding the class action filing threshold. You can't prove you personally lost $73 because the bank doesn't report the pre-rounded figures. So what do you actually do about this? You can't stop your bank from rounding, but you can minimize the number of rounding events. Move to a bank that pays interest monthly instead of daily. Fewer calculation events means fewer truncation events. If your bank offers interest compounding options, choose annual compounding over daily compounding. One rounding event per year instead of 365. For fees, the move is simpler. Switch to a bank that uses symmetric rounding or that discloses rounding policy in plain language. Ally, Discover, and Marcus all publish rounding methodology on their websites instead of burying it in legal definitions. That transparency indicates they're not using rounding as a profit center. You can also reduce the number of fee events. Every fee assessment is a rounding opportunity. Use in-network ATMs. Set up overdraft protection that pulls from savings instead of triggering fees. Go paperless. Each avoided fee eliminates a potential rounding event. For interest earnings, the better move is to get out of low-yield bank savings entirely. If your savings account pays 4.2% and truncates rounding, you're losing $947 per year on a $4,000 balance. A Treasury Direct account holding 4-week T-bills pays 5.3% with no rounding loss because Treasury securities calculate interest to 8 decimal places and round symmetrically. You'd earn $212 instead of $168. The rounding methodology matters, but the rate matters more. The real lesson is that banks make money in 2 ways. The way they advertise, which is interest spreads and disclosed fees, and the way they don't advertise, which is systematic rounding policies that move fractions of pennies from millions of accounts into bank revenue. Both are legal. Both are disclosed if you read 30 pages of account agreements. And both are designed to extract maximum value from customer deposits. Your bank isn't rounding randomly. It's rounding directionally. And the direction always points toward the bank. If that makes you want to check your actual account agreement, subscribe, and we'll keep showing you the specific fine print that costs you real money.